Hi, my name is Alex Carlucci with Gustan Associates. Today I want to talk to you about all the costs that go into buying a house so you understand it and you don't run from it and how we can manage it. Let's start with the very first thing you do. Let's say you go buy the house and they want an earnest money check. That's the first thing you have to spend is that earnest money check money. Let's say on average it's $1,000. The good thing is that $1,000 goes towards all your transaction costs of this whole process, so it's not an additional cost. Then your realtor or someone's going to suggest to you that you should get a home inspection, and they average from $300 to $500. So I recommend you get it. It's not required, but if you get it, it could be $300 to $500 out of your pocket up front. So now you have the $1,000 out of your pocket. Then you get the, let's say $350, because that's the average price that I see. $350 for the inspection. Inspection goes well, house is in good condition, then you go through the loan process and they make you get an appraisal. Appraisals run from $400 to $600 depending. Let's just say $450. So now you get the $1,000 for the earnest money, $350 for your inspection, $450 for your appraisal. You are now $1,800 out of your pocket up front. That's what's all you have to spend going forward up until you close. Now, the appraisal and inspection fee you cannot really get credited to you. The rest of the other costs you can. Let's go over the rest of the costs. Now, when you go to a mortgage company or bank, they all have an underwriting fee. Let's just say it's $1,000. That's a standard underwriting fee for $1,000. That's a closing cost that you're going to have to incur. Then you're going to have a title. So when you buy a house, the seller in general picks the title company, and you have nothing to do with it, neither do we. And that's a third-party charge that we just get from the sellers, and they're averaging around $3,000. So now you got $1,000 underwriting fee, $3,000 title. So there's $4,000 of cost that you're going to have to bring to the closing table. The other cost that you're going to have to also bring to the closing table is your insurance. So you're going to have to call around and shop for insurance, depending what state you're in. If you're in Florida, it could be $3,000 a year. If you're in Illinois, it could be $700 a year. So now let's just say on average it's $1,200. So you got $1,000 for the underwriting fee, you got $3,000 for the title, then you got $1,200 for insurance. So now you're $5,200 in costs you have to bring to the closing table, minus $1,000 earnest money that you've already put down. So you got those costs. Now what's going to happen is you're going to have an escrow account. And these are not charges, but it's costs that you have to bring to the closing table. Escrow accounts are money that you put into a little savings account that the bank holds for you, and they use it to pay your taxes and insurance when the due dates are due. So depending on what county you are, what city you're in, the tax dates, the due dates will affect how many months of taxes they're going to want to hold in that little savings account. Your insurance will always be due the day you close, the following year, and the following year, and the following year. So they want 3 months of insurance in that escrow account. So if your insurance is $100 a month, that'd be $300 in your insurance escrow. If your taxes are $200 a month, let's say your taxes are due in December and it's June right now, they'll probably want 6 months or 3 months or 4 months. Who knows what they're going to want? It all depends. But let's say it's 6 months to make it easy. So you got 6 months at $200 for taxes, that's $1,200. You got 3 months for insurance, that's $300. So there's another $1,500. Now you're at $6,700 in cost. Now in some counties you may have stamps, which that is, it's like a tax. The cities charge you, or the town charges you, the county charges you, the state charges you. It's like a sales tax. Let's just say it's $300 because a lot of places don't have it. Some places have very expensive. Now we're at $7,000 with 300 transfer stamps. And then the last thing is a cost is the interest per day. Interest from the day you close to the end of the month. It's like a mortgage payment for the rest of the month. It's like $30 a day for a small mortgage, $100 a day for a huge mortgage. But let's just say it's $30 a day. Let's say there's 10 days left. That's $300. Now you're at $7,300 that you need to close. So out of the $7,300 you need to close, let's say you're going after J plus a 3.5% down on a $200,000 loan. You need $7,000 down payment, $7,300 in closing costs. That's $14,300. You've already put $1,000 down on earnest money. That comes off there. So now you have to bring $13,300 to close. Ouch! That hurts. So this is how we structure at the beginning. We go over all these numbers, and they said, hey, you have $7,300 in closing costs and tax escrows and your insurance, minus the appraisal you paid out of your pocket. That's $7,300. Let's ask the seller to give a credit for it. When you ask the seller to give you a credit for that $7,300, So you build it in the purchase price. It's a $200,000 purchase price with a $7,300 credit. That means that the seller is getting $192,700 net. Even though you're buying it for $200,000, they're not going to net that because they're going to give you those closing costs to credit all your costs. So all you have to do is worry about that 3.5% down. That 3.5% down of $200,000 is $7,000. You've already put $1,000 down, $6,000 out of your pocket. And that's how I structure my loans, to make it easy on you. And that's what goes into the loan. I hope you like this video. Please give me a call at 630-915-7550. Go to gustanshow.com to see some more blogs. GUSTANCHO.com. Thank you very much.